discussion is on how to trade directionless markets, but in all fairness to the title, really what this is about, and the way I like to look at this topic of understanding what to do with directionless markets, is also understanding how to avoid them. So we really can't talk about one without bringing up the other. Okay, so as much as I want you to be able to create a focus list, I realize that at certain parts of the trading year, whether it be for a few weeks or a few months, you're going to deal with markets that don't have clear, focused trends that are on a mission. And I'll tell you what, one of the most difficult transitions to make is to go from a market that was once trending to one that is choppy. One that comes to mind pretty much before any other is the dollar yen. How many here, show of hands that I can't see, how many here are or were looking at the dollar yen, playing it long, and then now are completely befuddled by what it's doing? What you were doing probably between about mid-November and say mid-March, maybe even for some of you mid-May, if you were a trend follower, it was working like gangbusters. There was pretty much no wrong you could do in that dollar yen, no place you couldn't buy that you would not eventually see a higher high. And that was just the way it was going. And trends make a lot of us sometimes look better than our trading may really be. And trends sometimes, if you're on the other side of it, is just continually punishing. So why am I talking about trends if our topic is directionless markets? You know, you got to know the light to look at the dark, right? Who would Yoda be without Darth? We've got to understand trending markets in contrast to non-trending markets. I will tell you, throughout the course of this discussion, I don't want you for a moment thinking that I prefer non-trending market. I absolutely do not. I'm going to show you some strategies that I use, but more so, I want you to understand how to recognize a non-trending market and really put it to the back burner, and how to put trending markets really on your focus list, at the top of the list. So if you are a trader, I would rather that you not, just for the next hour, kind of suspend who you were and what you do, and just kind of buy into this reality for now that you are not a trend trader, you are not a non-trending trader, you're not a contrarian, you're not a top or bottom picker, you're not one who fades, you're not a swing, you're all of them, or you're kind of none of them. Just for an hour, just kind of buy into this belief that you can be any kind of trader you want to be. You should be a flexible trader. You should be a trader who's open to different kinds of strategies. And namely, you have to be a trader who is willing to step back, look at the market trend, and then respond to it. Not come with your own agenda, not come with a toolbox full of what it is that you like to do, but understand that within your toolbox should be a number of tools that will allow you to trade the way in which the market is behaving now. This goes back to the way in which Charles Dow and Dow theory impacted my trading more so than any other really philosophy. That's the most influential thing in my trading, which is to say that you have to be able to look at the market for what it's doing and not simply impose a trend following strategy or a fading strategy on the market. I cannot stress that enough. Okay, so just kind of think of that throughout the presentation here. And again, if you have any questions, please feel free to type them in. If there's a particular pair you want to look at, again, feel free to type it in. We can incorporate it into the discussion. All right, so kind of going back to juxtaposing the dollar yen, which we looked at a moment before, to say this pound US dollar. Is there a big difference between these pairs right now? Not really. Not a huge difference, because they're both in chop. They're both moving in a choppy, sideways manner. So at the moment, there really isn't that much of a difference. But before they both started chopping, more so the dollar yen, was in an uptrend. So traders who were willing to buy weakness, buy on pullbacks, take advantage of the moments when the yen was strong and or the dollar weak, and bought into those times, were pretty much, for the better part of, like I said earlier, mid-November to about mid-March or even mid-May, rewarded for doing that. All of a sudden, though, after mid-May, buying into those pullbacks, it really hasn't been working out all that well, has it? And the reason for that is the market trend changed. So how do you, number one, before you can handle and trade a directionless market, how do you even identify a directionless market? And what do I even mean by a market being directionless? So a direction simply means you've got a trend. But it's not enough to say that we have a trend. For me, it's more important to say that there's a trend on the daily time frame. And whenever we start thinking about trends in this current environment, the Aussie should come to mind in terms of the weakness in the Aussie and how Aussie pairs have been trending. The Kiwi should come to mind. Those individual currency stories with the Australian dollar or the New Zealand dollar, because of their weakness, we've been seeing a number of strong trends on pairs that involve those currencies. That's what I mean by direction. Take a look at what's happening on the pound Kiwi right here. Take a look at what's been happening on the Aussie US dollar. These are markets that have trends. They have direction on the daily. Why the daily, by the way? I focus on the daily not because specifically it's the one that I'm going to trade, although that is often the case. I do like end-of-day charts when I'm trying to follow these bigger fundamental stories, central bank type stories that are in the market. But I also believe that the most psychologically relevant time frame is the daily. It's the one that most people have the access to. It's the one that I find through the course of well over a decade of teaching traders and watching them, observing them, everyone from newbies to experienced traders to hedge fund managers to active day traders and scalpers. When you ask them what their overall opinion is of a pair or of a market, it doesn't matter really, this is not just specific to Forex, but you ask them what their overall opinion is. Sure, some of them might have opinions that are shorter term. It's usually going to reflect the time frame that they set up trades on the most. But when you inject that word overall, or if I say, what's the dominant movement in this market? What's the overall movement in this market? I'd say better than 90% of the time, the trader will go to the daily time frame and take their opinion from the price movement there. Now, maybe it's going to be a series of touch points and a trend line that ultimately yields an opinion. Maybe it's going to be the way in which the 20, the 50, and the 200 are lining up and moving that will yield their opinion. But undoubtedly, again, like I said, better than 90% of the time. And of course, it's anecdotal, but I've literally observed thousands of traders over the years. And I can say without a doubt, it's usually the daily they go to. So using that as my sample for what the market at large does, again, I'm not saying the daily is necessarily the most tradable. It's simply the one that I believe most traders turn to reveal the dominant movement in a market. So too will I. I'll do the same thing. So if I'm going to look to create a focus list, if I'm going to understand what a directionless market is, now those are two very different things. If I'm going to create a focus list, which is my watch list, which is the list of pairs that I will pay the most attention to set up trades, I'm going to look for markets like a downtrend that we see here on the Aussie US, or the uptrend that I see here on the pound Kiwi. Okay? Sure, I got a question here about the Euro Kiwi. You know, would the Euro Kiwi end up on my focus list? Just take a look at the daily chart of it. Absolutely. What am I looking at? It's really simple here, gang. And this is available through the Interbank FX MT4. So if you have the demo or a live account through IBFX, and I mention that, of course, because we're here for an IBX webinar, and of course, all my cards on the table. I'm the chief currency analyst for IBFX. They have built in the indicators that I use, my grab candles. Grab stands for green, red, and blue. They've built in my grab candles and my 34 EMA wave into studies that you can just drag and drop onto your chart. If you don't have a platform, have the IBFX platform, a platform that has these tools built in, don't worry. I just assume you download that, but if you don't, you can head on over to RagheeHorner.com and download it from there by searching Grab 2.0. Now, I want to mention that RagheeHorner.com is my personal website. It's not affiliated with IBFX or TradeStation or the Monex Group. So it's just a place where I actually have a personal blog, and you can check that out. But again, I would recommend that you just download the IBFX platform and you can just drag and drop it onto your chart. But what do I do with the grab and with the 34 EMA wave? Don't make this more complicated than it has to be or than it really is. Take the grab candles and look at what the dominant color of the candles are. As you can see here, for the most part, on this Euro Kiwi, I have a series of green grab candles. The light green indicates an up close, which would be akin to a hollowed out or white candle in more traditional Japanese candlestick analysis, or what you may be used to if you're using Japanese candlesticks. The darker shade of green would be akin to a shaded candle or a down close. So I still keep that traditional Japanese candlestick feel, but I also have the color coding. And when I have consistent green grab candles accompanied by a 12 to 2 o'clock angle wave, I have a trend. Now, I'm going to tell you, identifying directionless markets, which is the first step before you even think about trading them, right? Identifying directionless markets is usually easier by identifying whether or not the market's trending. In other words, if it's not trending, it's likely directionless. Now, according to Dow, we have really 4 market trends. You have your markup and markdown, which is more commonly known as uptrend and downtrend. And then you have 2 types of sideways or non-trending markets. You have distribution and you have accumulation. And the difference between the two has to do with the trading range and the volatility. Distribution has wider trading ranges typically and much more volatility, while accumulation is a narrower trading range with less volatility. Now, diehard Dow theorist, analysts would probably take another step and say, Raghee, you're omitting the fact that typically accumulation happens before an uptrend and distribution happens at the end of an uptrend. And that's all true. But because Charles Dow was talking primarily about the equities markets, which have a bullish bias. In other words, most people who engage in equities trading or investing get long. They buy. They're not really all that active on the short side. Well, when you're a trader in futures or Forex, you really do think about the short side much, much more often. In fact, in Forex trading, we say there's always a bullish market because, in fact, if I am buying the Euro Kiwi, obviously I'm buying Euro, selling Kiwi. But if I were, for example, looking at the Aussie US dollar, to take advantage of this downtrend, I am in fact selling Aussie dollar and buying US dollars. So it's a very different way of looking at the market in terms of the fact that you are always buying something. There's always a bull market on one side of the trade if you're looking at a trend. So even when I'm looking at a downtrend like this, I am in fact buying US dollars, right? Okay, so Charles Dow had that bullish bias because he was looking at equities, which trade predominantly with a bullish bias. So I am not necessarily limited by this opinion that accumulation only comes at the beginning of an uptrend and that distribution only comes at the end of an uptrend. So we'll see narrow sideways ranges and wide volatile sideways ranges at any point really within the context of a trend, because we can get distribution at the end of a downtrend, because in fact that uptrend in the US dollar could be causing some of that volatility. So think about that. I know I just threw a lot at you there for a moment, but think about that for a moment. So don't get stuck into the textbook definition of accumulation distribution. Realize what the characteristics are and let that be what guides you as to what it is you're seeing when you see a market with a wide sideways range versus a narrow sideways range. It's easier to identify sideways ranges when you eliminate the possibility that that market is trending. So in this case, when you go through the daily time frames of the pairs that you like to perhaps trade, you're asking yourself a number of very simple questions using the grab and using the 34 EMA wave. Let's take a look at the dollar Swissy here for a moment. This was a market that if you would have asked me last week, I would have said was in really a fresh trend or a young trend. In other words, it's pretty much synonymous. If I say something's fresh or young, that means the market has begun to trend. I've seen characteristics of what I want to see a trending market would be by way of the consistency of the red grab candles here, and it's accompanying at that point in time a 4 to 6 o'clock angle of the 34 EMA wave. But more recently, you can see what's happened. The wave has begun to lose that angle. In fact, if I were to extend out the middle line of the wave right now, it's barely hanging on to a 4 o'clock. So what I say to myself now is, well, do I have the characteristics of what I want to see in a downtrend, which would be the red grab candles in a 4 to 6 o'clock angle? Well, I can see that I'm getting some blue grab candles, which are neutral candles working their way in. Now, why do I color code this? I color code it because when you're looking across usually about 6 time frames, this is my reality. I'm looking at about 4 monitors in general, but I have no problem trading from my laptop. But I'm usually looking at 6 time frames per pair. So even 6 time frames can be a lot to digest at once. But then you start multiplying that by perhaps a dozen to say 16, maybe even 18 pairs, all of a sudden you are looking at a lot of charts. And to make your way through the analysis of every one of those pairs, you need to be able to make some quick visual decisions rather than having to dive in and do a lot of heavy lifting in each and every time frame for each and every pair. So if I can dismiss the dollar Swissy as really no longer being in a quality trend because I can see that the 34 EMA wave has begun to transition from what was a really nice, smooth 4 to 6 o'clock angle to now a little bit more of a shallow, barely 4 o'clock angle, and I can see the blue grab candles in here, I can immediately say to myself, this is probably a market that's doing one of two things. One, it's no longer trending with the same type of sentiment and momentum organization that it once had, but it might also be in transition. And when I mean transition, it might be in a directionless, might be transitioning into a directionless market. In other words, a sideways chop. So I'm going to immediately stop any kind of trend following approach, abandon those trend following indicators, and look through my toolbox, look through my list of strategies for those types of entries that would capitalize on a market that is either going to do one of two things when it comes to sideways markets. Either exhaust at the ranges of the chop or break out and follow through with momentum through the ranges of the chop. What determines why I do one or the other? And this is something that just gobbles traders' accounts up like a game of Pac-Man gone wild. A lot of traders are pretty good at realizing when a market is no longer trending. And a lot of traders are able to say to themselves, I'm no longer going to trend follow, I'm going to start looking at sideways market strategies. But those same traders sometimes don't know when to look for fading opportunities, in other words, opportunities where the market may exhaust at the extremes of the range, versus momentum opportunities where they may have a rectangle or a triangle or some sort of consolidation pattern where they would be better off looking for breakouts or breakdowns if indeed the market is consolidating. So this brings up one of the issues a lot of chart pattern traders have when looking at directionless markets. You'll see that triangles occur very often in directionless markets. But really, in order to trade a triangle, you have to be in some sort of transition from congestion into consolidation, or the way Charles Dow would say, from distribution to accumulation. In other words, from a market that is in a wide, volatile sideways range, but is quietly, slowly making the transition into a quieter, narrower, lower volatility range. So think about what a triangle does. It squeezes price action. And as it's squeezing it, what you end up with is a market that does what? It's a market that ultimately will begin to look at possibilities for that coiled spring, okay, versus that exhaustion at the extremes of the range. Okay? Is everyone clear with that? If you have any questions as I'm going through some of this terminology, which I know is kind of my own, or maybe you've never heard of it before, just let me know, and I will be happy to clarify, okay? Because I know sometimes traders have their own little secret language, and I'm no exception. So if you do have those questions, let me know. All right, so one of the questions here is, what are the other moving averages on my chart other than the wave? They're really not applicable for our conversation here. They're not really going to be highlighted, but they are the 20, the 50, and the 200 period simple moving averages. So thank you for that question. That was from Aditya. Thank you very much. Okay, so let's keep moving forward then. Another question I have here, it just came up, is how do you know when the trend is over and you should close out all your positions? Okay, so that is a great transition. Thank you, Zara. That's a great transition into what I want to talk about here today, which is leaving the topic of, if you are creating a focus list, I just assume you focus on markets that are trending. The reason being is there's a dominant overall opinion, and market movement is more predictable when traders are very confident about the up or down trend. Okay? But what about the directionless market? How do you know when a trend is over and you should close out your positions? So that has a lot to do with the transition, and that has a lot to do with the angle of the wave, and that has a lot to do with the color of the grab candles. So let's use that dollar-yen example again. So traders who were looking at the uptrend in the dollar-yen had a couple spots where they could have taken stock from a technical price basis of whether or not this trend really was going to be able to continue. There are 4 distinct spots on this chart where we should step back and ask ourselves what's happening to the trend. Now, you have to remember, technical analysis should not be the only thing you look at. Price action should not be the only thing you look at. And fundamentals should not be the only thing you look at. I consider myself none of the above or all of the above. I mean, however you want to look at it. I'm a chart hacker. I look at the fundamentals and how those are being discounted, if they're even being discounted, because just because a fundamental is being discussed doesn't mean that it hasn't, 1, already been discounted, or 2, being completely ignored. Technicals can be helpful, but they're not, again, the end-all be-all. Price action, again, is helpful, but price action alone without fundamentals won't let you know when there's going to be an increase in volatility and therefore risk. So you put them all together for a better picture of what the market is and could be doing. With that being said, how do you know when a trend is over? How do we know that this dollar-yen was starting to lose its grip? Well, here is a great example of where you have to understand and monitor the fundamental story, because up until I'd say this month, maybe late May, there was very little doubt about what it was that the BOJ wanted to do. So it was very easy when we started to see these tests to buy them, because the BOJ was really just, you look at their agenda and what they were doing, they were willing to step in and continue to weaken the yen. Most recently, though, traders started to doubt that ability. They doubted what the yen could do, and market sentiment began to change. When you see those type of headlines changing, when you see the traders doubt the BOJ's effectiveness, their ability to weaken the yen, and this whole currency war type conversation, traders then start to lose their confidence in selling yen. But that's kind of a subjective thing, isn't it? How do I know that? How can I see that? Well, we can see that in a couple things. One, we can see that in this larger, and by the way, if you were out of the trend in February, re-engaged it, out again, say end of March, re-engaged it early April, it started getting trickier through February on. I will absolutely admit that. Unless you were really confident in the fundamentals, it was difficult to hang on to some of these pullbacks. These two in particular, these two really, because they were the ones that, in fact, really, this was the main one. This was the one that broke the wave and the 50-period simple moving average, and probably shook traders the hardest throughout the, say, the latter third of the rally. Now, what happened here? The second breakdown. We broke the wave, we broke the 50 DMA, and like we had before during this break, the green grab candles went to red. Green grab candles went to red here as well. And unlike the previous time back in March where the bulls came running back in because the fundamentals were still very much watch out for the BOJ, keep the yen selling going. You got to remember what the Dow is doing at that time as well. Dow is moving up higher. Strong equities markets mean the carry trade is alive and well, and traders will sell the yen in order to fund their purchase of expectedly higher yielding assets, risk assets, and the yen continued to weaken. Most recently, we've seen a stall in the equities uptrend. We've seen a lot of fear in the equities markets. We've seen doubt as to what the BOJ could do. So suddenly, those stories that were so clear in March, and even in April, are no longer really there to help make the bulls confident to buy into the pullbacks or even some of the tests of the uptrend. Right? What's happened over the past, week to the Dow? What's happened to risk? It's risk aversion. Risk is coming off the table. Regardless of what the market did today, risk is coming off the table when you take a look at the last handful of sessions. That strengthens the yen. So how do you know when a pair begins to lose its trend? Well, visually, we can talk about the fundamentals all we want, but that's really a separate type of analysis. That's a separate series of steps and tools that I use. It's not difficult. It's just another series of questions that I ask the market, and not necessarily with the chart being the emphasis. But how do we use the chart as the emphasis to know the trend is over? The red grab candles, blue grab candles are kind of your warning because you're going from one sentiment to neutral, whether that be green to blue or red to blue. The grab candle shift should be one of your first easiest clues. And then the angle of the wave also should be a part of that conversation. So think about what happened. We're moving up higher, and then look as I follow the middle line of the wave. The wave is starting to move lower, the red grab candles are coming, and now we're actually moving a little bit more sideways. So when I take a look at the transition this market's had, there's no one magical spot that you're going to say the uptrend is over. Not necessarily. I mean, some of you might look to the first blue grab candle. If you're very, very sensitive to wanting to get out of the market at the first sign of a lack of bullishness, a blue grab candle could be it, but that might get you out a little prematurely. The red grab candle, I would say in this case, actually the 3rd of June was probably the first sign that things were really starting to go badly. And when you see that red grab candle, and I did the same thing back here in March, when you see that first red grab candle, you should start, or even the blues, you should start what I call Google News surfing. You go look at what are the headlines surrounding the yen. What are traders discounting? You'll see that immediately just by reading the headlines. What are their opinions now of the market? And when you start to see a landslide of the kind of sentiment that would strengthen the yen, that's what you know is being discounted into the market. And that is not what is going to empower or embolden the bulls to step in and support the dollar yen. So when you see a red grab candle in an uptrend, but you don't find those kind of headlines that would dissuade the bulls, you can feel confident that yes, it might be a little riskier, but the bulls haven't necessarily abandoned their trade. You're not seeing the fear being discounted into the market. But when you start to see the red grab candles and then the headlines really start to shift, in this case, the equities headlines really started to shift. The BOJ confidence in what they were doing in terms of weakening the yen really started to shift. If we have weak equities, a lot of times you're going to see a flight to safety into the US dollars. That means that the dollar could still be strong, but if the equities market starts to weaken, the yen too will be strong. And that means the yen and the dollar are duking it out. They're fighting to strengthen each other. That's not going to give you a great trend. In fact, great trends come from imbalance. The trend was so great here, not necessarily because the US dollar was so strong, but because the Japanese yen was so very weak. And when you lose that sentiment, when the headlines are not reflecting that traders feel that that market is still so consistently weak, you're going to see the blue grab candles come in. You're going to see the red grab candles come in. So even if you're not necessarily on top of the headlines and or fundamentals, don't worry. It's being discounted. It's going to change the angle of the 34 EMA wave, and it's going to change the color of your grab candles. That's how you recognize it. Now, you don't want to abandon ship all at once. It depends upon the time frame you're trading and, of course, how deeply entrenched into the trend you are. I'll give you an example here. I have a couple trades where I am pretty deeply entrenched into some longer term trends. The pound Kiwi comes to mind. This has been a great trade for me. You can see where I'm long from. Even though we've had some significant pullbacks, and this one is probably one of the more significant ones, okay, does that really affect me from a positioning down in here? This is where you have to ask yourself on pullbacks, who is being shaken out of the market? Who's being shaken out of the market on that pullback? Typically near-term buyers that were relatively recent in engaging the uptrend. Longer-term buyers really are probably pretty comfortable sitting through that, and ultimately they will wait for the story that they still feel is valid, which is, and it's going to be kind of interesting because we do have, and I'll be watching it closely, we have a 5:30 a.m. hot zone tomorrow with the BOE and the Financial Stability Report. Mervyn King will be giving a speech in London as that Financial Stability Report is being released at 5:30 Eastern. So if part of this trend is strength in the pound sterling, that could impact my trade. But the driver of this trade really is the weakness in the New Zealand dollar. So even if the BOE and King and the pound begin to hurt the strength I see in the pound sterling, as long as my Kiwi is weaker still, I shouldn't have a problem maintaining the uptrend in this pair. So that's another question. What's the driver of the movement in your pair? Is it necessarily my base currency strength, in this case the pound sterling? Not really. It's really more about the second currency weakness of the New Zealand dollar. Okay? So with all that being said, let's go back to a market that is perhaps choppier and a little less quality of a trend, a younger trend. Let's talk about this in phases here. This is a good definition of a young or fresh trend. By that I mean, we see the downtrend that's occurred. I have consistency in the red grab candles. I do believe it to be a downtrend, but it is not established. When you are engaging a trend that is not established, there is the possibility, and you really should expect it, you should work this into your expectations for risk. And therefore, I think if you're engaging a young or fresh trend, you should definitely have a higher risk tolerance. Okay? So this is a trend that has recently transitioned. Notice how we went from, and we've done this before, by the way. This looks very reminiscent of the dollar yen. But notice again, when did we test the trend? What was the sentiment about the BOJ? And again, we've tested the trend here, and the sentiment about risk equities globally and the yen is very different here in May than it was in February and or March. We have gone from blue grab candles to red. The red has begun to sink to lower lows, and it drug the 34 EMA wave down with it into a 4 to 6 o'clock angle. This is a fresh trend, but it could be much, much more volatile. Some traders may still be hanging on to some of what was the dominant trend over the past year, which was up. And since this market is still above, it's still north of the 200 period simple moving average, there are traders who may fade this very important technical level. Now, the 200 DMA, or the 200 daily moving average, which is just the 200 period simple moving average on the close, that is, of course, a technical. But it is such a well-watched technical that it really takes on much more psychological relevance than just being a technical. Fundamental traders will observe it and respect it. Price-based traders will observe it and respect it. And of course, technicians do as well. But there is a chance that you will see a fade along this very fresh trend as it meets the support of the 200 period simple moving average, or the 200 DMA, daily moving average. So while I would not call this a directionless market, you have to be ready for the fact that the market's been supported in this area before. It might be again, and this time around, it's got the 200 period swooping up with dynamic support. A market that I've heard a lot of people talk about, but I find it has no direction, but it's had a lot of volatility as of late, is the euro pound. Let's take a good look at this market. You know, it's very easy to determine that it's not moving in the trend because we really don't have consistency of any particular grab candle, and the wave is flat. Now, the reason I spend so much time talking about trends is because, one, those should be your primary focus, but two, once you recognize what a trend is, identifying what a non-trending market is becomes very easy. What do I do in this non-trending market? Well, a couple things. What was the preceding trend? What was the preceding sentiment? Let's take a look at the dominant green grab candles through most of the year. I'm looking at July to July. So for the past year, most of the trend has very much been up, dominated by green grab candles. I had a little bit of red grab candle back here late last summer, and I had some red here, and then it went to green, and then it went to green again. But notice how in between all those reds and greens were the blues. Here's some blue here, some blue there, a little bit more blue there. So we're having very quick transition from blue to red to blue to green to blue, right? No one grab candle color is really dominating, and therefore notice that the 34 EMA wave is just kind of slopping sideways across the chart. Very different look this is compared to this, right? Very different look. Very different set of grab candles that are creating it. So what do I do with this pair? You have two choices, and I'm going to be very frank with you. This should absolutely be on the back burner. I don't care what the fundamentals are. I don't care what the economic events are. This is like a car. Okay, you guys remember that movie True Lies? Probably one of the best Schwarzenegger flicks ever. I don't care about the man's personal life. It is a great, great movie. Who's seen it? Okay, so if you've seen it, there's a scene that was shot down here in Florida, actually down in the Keys. And it's the very end where his wife is in the limo. If you remember, Jamie Lee Curtis played his wife who didn't know that her husband was a secret agent spy. And somehow or other, the guy in the getaway car, this limo, had been shot. He's dead. And the car is just careening side to side down this bridge, out of control. And the bridge is out. So Schwarzenegger's got to get to Jamie Lee Curtis and rescue her. But that car careening down that bridge with nobody driving it is exactly what this Euro-Pound is. I want to market, I don't care if it's Forex or futures or stocks or what. I want to market where I know somebody's behind the wheel driving it in a particular direction. That's going to give it organization, and that's ultimately what is needed for a trend to continue. Volatility is not what makes a trend. Volatility makes price movement, but it's the organization of that price movement that creates a trend. Does a car careening down the road without a driver have organization? Definitely not. This is exactly what this is. So one session the bulls may be in control, one session the bears may be in charge and in control, and it keeps flip-flopping back every session or two or three. But ultimately, nobody has their hands on the wheel, and therefore you can see it's really just gone from congestion to consolidation. The congestion can be seen here with the wider trading ranges and the shorter spans of time that we're in either a 12 to 2 or a 4 to 6 o'clock angle, until finally it's moving sideways, not all that smoothly, and in a fairly wide trading range. If the trading range narrows, the wave will flatten out, literally just become flat and smooth. As long as you see some shake in this wave, when you look at the moving averages of the wave and there's still some lump and bump to them, that means there's still volatility. It's the range in the candles that's keeping those moving averages from smoothing out and just moving flat at what I would call 3 o'clock. The difference between a flat wave and a kind of a lumpy, bumpy 2 to 4 o'clock wave is the difference between consolidation, where we have a narrower, lower volatility trading range, and congestion, where you have that higher trading range, the wider trading range, more volatility, and therefore you're seeing a little bit more in terms of confusion in the market. If you want to juxtapose the emotion kind of between accumulation and distribution, or between consolidation and congestion, congestion's confusion. Consolidation's darn near boredom. Okay? So in a congestion market, you're typically going to see channels and or triangles form. But when you have the quick transitions from blue to green to red on the grab candles, when the wave still has a little bit of lump and shake to it, that means we have higher volatility, and you should typically expect the market to exhaust at the range highs. In this case, we have a pretty good idea of the range highs because I can draw a line, basically a resistance line around this area here, just shy of 8,600. I love that it's sitting in front of a major psychological level. The support's a little trickier because near term I have a little bit of support right there. When I say near term, the most recent lows. Let's put a green line in there. A little bit of, I have some lows in this area, just right around the 84.71 area. But then I have another set of lows down here. So the support is going to be a little trickier because if the support doesn't kick in at these recent breadcrumb lows, where the market's made these lows in here, it's going to go down to where the market's possibly made these lows. That's just the next level the market might go test. Okay? So what I do in this situation, if I want to trade this market, this directionless market, as long as it's lumping around with the quick transition between the greens and the reds and the blues and kind of a shaky sideways wave, I'm going to look to fade the resistance. And that would mean selling up in this area and buying down in one of these two areas. So a fade simply means that when we have some strength and we reach the ceiling, I'm going to sell it. And here's the interesting thing. If I gave this chart to 10 people, I think most people would probably draw the same horizontal levels that I've drawn here. They might vary by a few pips depending upon which wick or body someone draws, but I think it more or less would look like this. The difference between trading and reactions and decisions, therefore, is not necessarily the lines and levels that we draw on a chart, but rather what we decide to do at them. That's really what differentiates trading reactions, traders themselves. What a level means to them. These are decision levels. Some traders might look at that resistance level and say, I want to buy that when prices break it. Other traders are going to say, if prices test that level, even if they break it by a little bit, I'm going to sell it. Some traders might look at these support levels and say, oh, if that support level is broken, I'm going to short the market. That's a momentum trade. Others might say, oh gosh, if we start testing that level, I'm going to buy it. It's an exhaustion area. So they might be making decisions at exactly the same price area, but they're on two different sides of the market. That's what makes the market go round. I mean, you look at any time you buy, someone's on the other side of your trade. How come? They're looking at the same market, they're looking at the same open, high, low, close as you, but their decision at a particular level is the complete 180 from yours. The way I decide what I want to do at a support or resistance level has everything to do with the underlying trend. So in a lumpy, bumpy 2 to 4 o'clock directionless market, I'm going to take advantage of the exhaustion at the range extremes, preferably these range extremes. I might even buy near term here with a tight stop and then recalibrate and buy again down here. If the market begins to flatten out and the volatility drops and I see more blue grab candles, that will tell me that we're probably going from congestion to consolidation, which is more like that coiled spring. And if we do break support or resistance, there's more likely to be follow through higher or lower. That's a momentum trade. It's more pure momentum rather than the expectation for exhaustion. So the subtle nuances of which grab candle is dominating, and if I start to see a string of blue grab candles and I see the volatility drop, I better stop and ask myself and reconfirm whether or not the market is 2 to 4 o'clock choppy congestion distribution, or whether it is then now turning into more organized, narrower accumulation consolidation. Okay? Is the noise getting turned down? Is the market getting ready to coil and explode versus the expectation I have right now for exhaustion at these range extremes? This is a tougher way to trade, I will tell you, because we don't ultimately know. This is that going back to true lies, right? It's that car careening down the bridge. It's much tougher. It's way, again, when I say easier, nothing about trading is quote unquote easy, but if you're talking about the psychological understanding of what's going on behind a market, it's much easier to understand what a dominant trend is more likely to do than one that's not a dominant trend. Okay? There are traders who have tried to pick a bottom because this market is parabolic, gone too far, it's overcooked, there's too many, all the reasons traders might have for what has been an enormous drop here in the Aussie US. The whole way down, somebody out there bought any one of these lows for any one of the reasons saying the market's gone too far down. There's no such thing as too far down, gang. And the only people who are looking to buy into a downtrend are the people who aren't already short, making it really the most well-disguised revenge trade that there is. I'm being absolutely frank with you. If you're constantly looking for that level at which the market's gone too far and is going to turn around while it's trending, you are absolutely, positively revenge trading. Ask yourself for a moment, what's the easier trade? Just following the trend or trying to take advantage of these moves? Because somebody here bought this level and probably wrote it up and said, haha, I got the market. Look at that. I took some money out. Wouldn't it have been easier just to take the ride down rather than claw and scrape and swim upstream for a little while? I think so. I think swimming upstream sounds exhausting. The only creatures that I know swim upstream are salmon, and that's usually right before they're going to die after spawning. How's that for a lesson from nature about not counter-trend trading? And again, we're talking about a trend defined by the daily time frame. If you were to run into a 15-minute time frame and take advantage intraday, short term, of these little pockets of strength that lasted sometimes better than a week, that's fine. You took a short-term time frame and you swam upstream for a little while, and that was it. Knowing that you were swimming upstream, knowing that you weren't trying to take advantage of a reversal, that's fine. And that's a topic for another day. But if you're really trying to trade what is the overall sentiment of this market, it's absolutely down. Okay? There's just no question in my mind about that. So I would rather you focus in on these types of pairs and not markets that are not trending. But are there ways to trade directionless markets? You know, in a lot of ways, it was really my intention to make sure you kind of learn to recognize what a directionless market is and, quite frankly, avoid it. Go find the markets with a direction and go trade those. Okay? And yes, I absolutely determined the trend, the dominant trend on the daily. Now here's where the intraday time frames come into play. So if I'm determining the dominant trend on the daily, because the daily is the most psychologically relevant time frame, what I then can do, let's say I have a non-trending choppy market. I don't have to trade the daily on this euro pound. I don't have to. I mean, obviously I have a number of other time frames I can look at. So here are some guidelines. If you want to jot them down or later on when you're reviewing this video, here are the guidelines. In a choppy market, if you're fading the daily, that's fine. Or if you're looking for a momentum breakout or breakdown on the daily, that's fine. But in the meanwhile, if you are going to trade it intraday, do so on the short-term time frames, 5, 15, 30. Remain nimble, get in, get out, because you don't know, given any session or even mid-session, when the bulls are going to lose control of the bears or the bears are going to lose control of the bulls. Remember, it's that car careening down the bridge, right? So remember that there's no organization, therefore you really shouldn't commit yourself to longer-term time frames for any kind of trend like the 60 or 240. So stay nimble, 5, 15, 30. Okay, that's when you have a non-trending, directionless daily time frame. If you have a time frame, and by the way, there's no such thing as counter trend really, because there is no trend. Now, flip that for a moment to a market that is trending, okay, like the Aussie Loonie. So in the case of the Aussie Loonie, what are you thinking about doing? In the case of the Aussie Loonie, you're looking at an overall trend moving lower. And this is the same thing that we'd be talking about, say, on, I think, an Aussie yen, which I'd love to get a piece of. You see a market that's moving lower. So when you have a trend on the daily, you can follow that downtrend across any time frame. In fact, if you're going to trade the 60 or the 240, I would recommend that you only trade those two time frames short. Trend following on the longer term time frames, because if you're committing to a longer term time frame, you don't want to be swimming upstream, so to speak. If you do have an opportunity to take a buy, you do so only on the 5, 15, and 30, being nimble, knowing that you are, again, going against the trend, swimming upstream. So you limit those to the 5, 15, and 30-minute time frames. And those are really the guidelines, okay? All right, I see a number of questions here. Where can you get Grab for the TradeStation platform? I don't believe it's available quite yet, Ahmed. I have not really coded it. If you are interested, I know at some point we'll have it available. I just don't know when that'll be. But you can put the wave on the TradeStation platform, no doubt. How do I know when the trend is over? We talked about that, Zara. Thank you for that question. About the Aussie pairs, what is the ultimate target for my trades? Tomac, that's kind of outside our conversation here today, because then it's going to get into a lot more about the actual entries, and I don't want to lose anybody. If you want, as far as that goes, what I would tell you, I really don't have an answer that I could give you that quickly here. I apologize. Essentially, what I would tell you to do, though, like for example, I'll just use the Aussie US. I look at all the major double zeros, but the truth of the matter is, it really depends on where you're positioned from. If you're positioned from deep within the trend, you might be really in a trailing stop scenario where you're just giving the market its daily pip movement range to move, and you're just kind of trailing it down, ratcheting it down. I don't necessarily recommend that if you're past the first or second profit target, that you should have another profit target. You really should just kind of at that point squeeze the trend, okay? If you're interested in that, I know we have other videos at the YouTube channel, tradeforexfeatures.com, at youtube.com, Interbank FX videos, youtube.com/Interbank FX videos. All right, next question. I do determine the trend on the daily. That is absolutely correct. I do trade off the 130 and 15, 15, 5, 15, 30, 60. But the time frame is really going to depend upon the clarity. And I know I have video on market clarity at the YouTube channel. So that which time frame I choose to trade is really going to depend on market clarity, and we have had presentations on that. Okay. What would be my target on the Aussie Swissy? Again, I don't want to get into. Hey, Ski, how are you? I don't want to get into targets and everything right now here, gang. But if you do have any questions on that, you can either follow me on Twitter or go check out that link I just gave you. But as far as, just really quickly, on the Aussie Loonie, I'm actually just squeezing the Aussie Loonie right now. I mean, I have some other positions I want to get into, but this is an overall trend that I know is very volatile right now. I'm taking some heat on one position, on my aggro position, and I'm but break even on another. But I'm really just looking to follow the trend. So I'm really looking just to squeeze this thing. I may not have a profit target in mind per se. I think perhaps the 95.80 area might be a good place. Even 96.05 might be a good place to take an initial profit target. But I'm really looking just to squeeze this, if at all possible, on the way down. I'm not really looking for a hard and fast level just to get out and get flat. So thanks for the question. Do I ever use the weekly? I'll use the weekly if I think that there are key levels that we may be running into in terms of longer term support and resistance. I will look at it maybe about once a week, if even that often. But I really don't use the weekly a lot. But like, for example, with the Aussie Kiwi, we have been in this area before. So it doesn't surprise me that we're getting some volatility in this area now. But quite frankly, we've been able to punch through that level. And I look at those punches through as potentially foreshadowing, where eventually we're just going to catch up with that and head back down to those lows. And a lot of what's going to count is whether or not I think the weekly is in a trend. So the same type of trend analysis that I would have on the daily, the grab candles and the wave angles, I'll apply to the weekly or even the monthly for that matter. Okay? Thank you, Ski. I appreciate that. You're going to make my head swell. All right. So fundamentally, which currency are the most bullish or bearish at the moment? I will tell you right now, my favorite two currencies, Jerry, are the Aussie and the Kiwi. Those are two very weak currencies with good dovish central banks behind them. The weakness in China only exacerbates it, and that's really what primarily my trading book is comprised of right now. I am trying to take advantage of almost, I won't say exclusively, but my trading book is dominated by Aussie and Kiwi positions. Absolutely dominated by them.